In trading, the illusion of consensus is one of the most dangerous traps a trader can fall into. It begins with the feeling of safety in numbers. When you see a chart pattern that everyone else is talking about, or when you hear every trading community buzzing about the same breakout, it's tempting to believe you've found a golden opportunity. It feels right because it feels shared. Yet this very alignment is what destroys profitability. The market doesn't reward obvious behavior. It punishes it. When the majority of traders pile into the same trade, they create a crowded room where there is no advantage left. Everyone is entering at the same time, setting their stop losses in predictable places, and waiting for the same confirmation. The professionals, the big players, already know where the herd is standing, and they position themselves to exploit it. Consensus thinking in trading is built on the illusion that the market works like a vote. Many believe that if enough people see the same thing, it must be true. If 1,000 traders all see a bullish flag forming, then surely the price will rise. But the market is not a democracy. Price doesn't move because everyone agrees it should. It moves because money flows in a certain direction, and often that flow has already taken place before the masses even notice. By the time the herd sees a setup, the move is already priced in and they are chasing shadows. The illusion is also fueled by the psychological comfort of not being alone. A trader who loses money on a unique idea feels exposed, almost foolish. But a trader who loses money along with thousands of others can at least say everyone thought the same thing. This safety blanket is what drives so many into predictable losses. They would rather fail with the crowd than risk standing apart. But in markets, safety in numbers is an illusion. The crowd doesn't protect you. It destroys you. You see this most clearly in earnings reports or big news events. Leading up to the announcement, the market consensus forms around a particular expectation. Analysts, social media, and retail traders all point in the same direction. When the news finally hits, instead of the expected rally or crash, the market often does the opposite. Why? Because the smart money positioned themselves long before. And when the herd comes rushing in, their orders provide the liquidity that big players need to exit. The crowd becomes fuel for the professionals to lock in profits, while the latecomers suffer. This illusion extends to technical indicators as well. Think about how many traders use the exact same tools: RSI, MACD, moving averages. These indicators, while valuable in understanding momentum, are not magical entry or exit signals. When 99% of traders place their trades at the same levels, when RSI hits overbought or when a moving average cross appears, the edge evaporates. If the signal is that obvious, it's already priced in. The herd reacts while the market moves ahead. What separates the rare independent trader from the crowd is the ability to see consensus for what it is: a trap. Consensus doesn't mean certainty, and it doesn't mean safety. More often than not, it means you're late. The price you're chasing has already moved, and the professionals who moved first are waiting to offload their positions onto you. The illusion works because it feels logical. If everyone sees the same bullish chart, then it must be bullish. But markets thrive on deception. The more obvious the setup, the less likely it is to deliver the result everyone expects. Consensus thinking also limits growth. When you think the same way as the herd, you stop questioning. You stop analyzing deeply. You stop asking, what does the market not see? The best trades don't come from what everyone is already looking at. They come from identifying what most people overlook. The trader who develops this mindset learns to anticipate where the crowd will go and then gets there first. Instead of being part of the herd, they learn to use the herd as fuel. The illusion of consensus thrives on social validation. It's reinforced by group chats, forums, influencers, and endless streams of analysis that echo the same conclusions. Each voice repeats the same pattern, and the trader feels reassured. But what feels like confirmation is actually a trap. It's not that the pattern or setup is invalid, it's that its visibility makes it useless. By the time it reaches mass awareness, the opportunity has already shifted. Breaking free from this illusion requires courage. It means being willing to look foolish in the short term, to place trades that others might not understand, to exit when everyone else is entering, and to step aside when the crowd is screaming certainty. It requires embracing the discomfort of independence and rejecting the false security of consensus. The trader who learns this understands that markets do not reward the obvious. They reward the prepared, the contrarian, and the disciplined observer who sees beyond what the crowd sees. In trading, emotions are not isolated. They move through the market like invisible waves, connecting traders in ways most do not even realize. This is the reality of emotional contagion. When one trader panics, another feels it, and soon an entire group is acting on impulse rather than strategy. In environments where money is at risk and prices flash rapidly on a screen, emotions can spread faster than reason. What begins as one trader's fear of losing quickly becomes a collective stampede. You can see this most clearly when markets take a sudden turn. A red candle appears, then another, and before long, the chart looks like a free fall. The first trader exits in fear. Another follows, and soon the selling pressure feeds on itself. Traders are not only reacting to the chart, but also to the anticipation that others are reacting. It becomes a cycle of expectation, where fear of what others might do drives action more strongly than logic. This is how the herd locks itself into losses. They are not responding to the market as it is, but to their collective projection of panic. Emotional contagion also works in the opposite direction. Greed. When prices rally and the market climbs steadily upward, traders begin to feel that the move will never end. Each green candle whispers, "You're missing out." Social media amplifies this by broadcasting success stories and screenshots of profits. Traders see others winning, and instead of thinking rationally, they feel the pull of envy and excitement. Soon they are not entering trades because of strategy, but because they cannot stand the idea of being left behind. What follows is predictable. They buy into the top right when the early movers are taking profit. The danger lies not only in individual losses, but in the way these collective emotions distort perception. Under the influence of fear or greed, traders misinterpret signals, overestimate risks, or underestimate danger. A chart that looked manageable suddenly feels overwhelming in a panic. A resistance level that was clear becomes invisible in a surge of euphoria. Emotions blur objectivity, and when many traders think alike in this state, the effect compounds. Rational decision-making disappears under the weight of collective feeling. This phenomenon is not accidental. Market structures are designed to amplify emotion. Price movements are displayed visually as red and green, triggering primal instincts associated with danger and safety. News headlines exaggerate developments, pushing fear or greed into overdrive. Social media thrives on dramatic narratives, spreading emotional energy across thousands of traders instantly. In this environment, the ability to remain calm is not just a skill, it is an edge. Most cannot resist the pull. They join the herd, swept up in the flood of shared emotion, only to realize too late that they were trading someone else's feelings rather than their own plan. The psychology behind this can be traced to a human survival mechanism. In ancient times, following the group increased the chance of survival. If the tribe ran from danger, it was safer to run too, even without knowing why. That instinct has not disappeared. In modern markets, when traders see a wave of selling, they instinctively believe there must be danger, so they join in. When they see a wave of buying, they assume opportunity is slipping away, so they rush to enter. What once protected human survival now sabotages financial survival. Professional traders and institutions understand this dynamic. They know that when panic spreads, liquidity will flood the market as retail traders dump positions. They know that when greed peaks, new buyers will rush in at inflated prices. Institutions plan for this behavior and use it to their advantage. They wait for collective fear to create discounts, and they patiently sell into collective greed when demand is at its highest. The herd's emotional alignment provides the liquidity the professionals need to execute their strategies. For the retail trader caught in this cycle, the challenge is breaking free from the emotional web. That requires developing awareness of when emotions are being borrowed from others rather than arising from objective analysis. When fear spikes, ask, am I reacting to the chart or to the panic I sense in the market's collective energy? When greed tempts you to chase, ask, is this my conviction, or am I simply caught in the excitement of others? These questions are the starting point for detaching from the herd's emotional contagion. The truth is that most traders lose not because of their strategies, but because they cannot separate themselves from collective fear and greed. They think alike, feel alike, and act alike, and in doing so, they create predictable waves that the market exploits again and again. The trader who learns to recognize emotional contagion and resist it gains a unique power, the ability to remain independent when others are losing control. Instead of being swept away by fear or blinded by greed, They become the observer of these forces, using them as signals rather than falling victim to them. Trading attracts people with the promise of freedom. But most traders unknowingly lock themselves into cages built from common strategies. The majority find comfort in what everyone else is doing. The same moving averages, the same MACD crossovers, the same head and shoulders patterns. At first, this seems logical. If thousands of traders and countless books recommend a method, it must have some value. And indeed, these tools can provide insights. But what most fail to understand is that when a strategy is used by the crowd, its edge disappears. Markets are adaptive, and once a pattern becomes obvious, professionals adapt to exploit those who cling to it. There is a reason so many new traders obsess over indicators. They provide the illusion of clarity. A line crossing another line feels like a decision maker. A pattern forming on the chart feels like certainty. When you are overwhelmed by the chaos of price movement, a familiar setup feels like a life raft. This is why traders hold on to them tightly. They fear the uncertainty of the market, and these strategies give them something to believe in. But the truth is that this comfort is expensive. It costs traders their independence, their adaptability, and eventually their capital. Take, for example, the moving average crossover. Almost every beginner learns to watch for the golden cross or death cross. It's simple, it feels reliable, and it gives a clear signal. But by the time that cross occurs, the big money has already moved. Institutions don't wait for lagging indicators to tell them what to do. They create the very momentum that pushes those averages into alignment. Retail traders pile in once the signal appears, thinking they are smart. But in reality, they are the liquidity providers for those who were early. The very popularity of the strategy ensures that it no longer works consistently. Another example is chart patterns. Head and shoulders, double tops, bull flags. These are taught in every trading course, and they have historical validity. But markets evolve. Algorithms now scan for these patterns at lightning speed. And professionals know exactly where retail traders will enter and where they will place their stops. The herd thinks it is being clever by spotting a textbook formation, but what it is really doing is advertising its intentions. This makes it easy for larger players to trigger stop hunts, reverse the move, and leave the majority scratching their heads. The comfort of common strategies also extends to risk management, or rather, the lack of it. Many traders copy the same approach to position sizing or place stops at round numbers because that's what they read in a forum or book. Once again, this predictability makes them vulnerable. A stop placed at an obvious support line is no different from waving a flag to institutions saying, "Here is my exit." And when the herd does the same, it creates a pool of liquidity that smart money exploits repeatedly. What keeps traders locked into these common strategies is not just habit, but fear of standing alone. If they fail using a popular method, they can justify it by saying, "That's what everyone does." But if they fail using an unconventional approach, they carry the weight of responsibility alone. This fear drives them back into the arms of the crowd, where they feel safe but doomed. The comfort of being wrong together is more appealing than the risk of being right alone. This reliance on common strategies also stunts growth. A trader who never moves beyond textbook setups never develops true market intuition. They remain dependent on external rules rather than cultivating internal judgment. As a result, they can't adapt when markets change. They cling to the same old signals even when those signals stop working, insisting that the problem is temporary, rather than realizing that the market itself has evolved. In this way, common strategies become a prison. They limit creativity, block adaptability, and ensure mediocrity. The truth is that no indicator, no pattern, no strategy holds permanent power. They are tools, not guarantees. The traders who survive are those who learn to use tools as guides rather than crutches. They understand that the market's edge shifts over time, and they must shift with it. They stop seeking comfort in commonality and begin seeking confidence in their own independent analysis. Comfort feels good in the short term. It gives the illusion of control, the reassurance of belonging, and the hope of predictable results. But markets are not built to reward comfort. They reward those willing to be uncomfortable, those who step away from the herd, and those who embrace the uncertainty, rather than trying to mask it with familiar tools. The comfort of common strategies seduces 99% of traders into predictable patterns of behavior, and predictable behavior is the one thing markets are designed to exploit. One of the greatest dangers in modern trading is not a lack of information, but the overwhelming flood of it. Traders today are bombarded from every direction: economic calendars, financial news networks, social media threads, endless YouTube channels, trading forums, and newsletters. What begins as a search for clarity quickly turns into an overload that clouds judgment. The trap of overinformation is subtle because it disguises itself as preparation. A trader feels that by consuming more they are arming themselves with knowledge, when in reality they are confusing themselves into hesitation and reactive decision-making. This trap starts with the illusion of control. Traders believe that if they gather enough reports, indicators, and expert opinions, they can eliminate uncertainty. They scroll through Twitter feeds before placing a trade. They listen to analysts debating on television. They check 5 different indicators to confirm the same idea. But the market never moves in straight lines, and no amount of data can eliminate uncertainty. Instead of building conviction, this flood of input breeds doubt. When one source says buy, another says sell, and a third says wait, paralysis sets in. The trader freezes, unable to act, and when they finally do, it is usually late. The problem deepens because most traders are all consuming the same sources. When everyone is reading the same headlines, watching the same breaking news, and reacting to the same economic reports, the herd mentality strengthens. Traders convince themselves they are making independent decisions, but in truth they are recycling the same information as thousands of others. This collective alignment creates predictable reactions. An inflation report comes out hotter than expected. Headlines scream panic, and retail traders sell en masse. Meanwhile, professionals already anticipated this reaction and positioned themselves to profit from it before the news was released. By the time the herd reacts, the edge is gone. The flood of overinformation also feeds into emotional volatility. A trader who constantly refreshes, feeds, and listens to every market opinion begins to feel the highs and lows of each headline. A positive report sparks greed. A negative one sparks fear. Instead of calmly following a plan, they are tossed around like a ship in a storm. They chase trades because of a tweet, each trades because of a rumor, and enter trades because of a YouTube prediction. This constant exposure to noise erodes the ability to think clearly and independently. Another effect of overinformation is the constant search for certainty. Traders feel that somewhere, hidden in the sea of data, lies the secret answer that will guarantee profit. This belief drives them to consume endlessly, without ever taking action with discipline. They spend more time looking for the perfect signal than executing a consistent plan. The irony is that the market does not reward the trader who knows the most. It rewards the trader who can act with clarity on the right information. Too much information paralyzes rather than empowers. There is also a hidden time cost. Hours spent reading every headline or analyzing every indicator are hours not spent refining execution, developing discipline, or reviewing past trades. Traders convince themselves they are working hard because they are consuming, but they are mistaking activity for progress. Information by itself is not power. Applied knowledge is power. Without focus, information becomes a distraction that drains time and energy, while delivering no real advantage. The professionals understand this. They don't chase every headline or every analyst opinion. They filter information ruthlessly, choosing only what aligns with their strategy. They know that markets move on perception, not facts, and that by the time something becomes widely known, it is already reflected in price. While retail traders scramble to process the flood of information, professionals stay calm, focused on what matters, and wait for the herd to overreact. The trap of overinformation is particularly dangerous because it feels productive. A trader who spends all night reading reports or watching financial news feels prepared. They mistake data consumption for edge. But the more they consume, the more conflicted they become. Instead of sharpening their decisions, they dull them with hesitation. When the moment to act comes, they hesitate, and hesitation is the silent killer of opportunities. Breaking free from this trap requires a shift in mindset. It is not about having more information than everyone else. It is about having the right filter. Discipline comes from knowing which signals matter and which are noise. Independence comes from trusting your own process rather than drowning in other people's opinions. The market does not reward the trader who consumes the most. It rewards the one who acts with clarity when others are lost in confusion. The trap of overinformation ensures that most traders move with the herd, But those who learn to step away from the noise discover an edge that the majority will never find. In trading, rigidity is one of the fastest paths to destruction. The market is not static. It is a living, breathing entity that changes character across timeframes, economic cycles, and technological shifts. Yet most traders approach it as if yesterday's rules will always apply tomorrow. This lack of adaptability is why so many continue to lose even after years of experience. They cling to what worked once, ignoring the fact that markets evolve, and in doing so, they set themselves up to be blindsided by conditions they never prepared for. Adaptability is not about abandoning structure. It is about knowing when structure must bend. Many traders refuse to adjust because of pride. They learned a particular method, perhaps a technical pattern or an indicator-based system, and it gave them early success. That initial success becomes an anchor. They convince themselves that if they just keep applying the same rules, the market will eventually reward them again. What they fail to realize is that the market does not care about their rules. A method that worked in trending markets may fail miserably in ranging ones. A strategy that thrived in low volatility may collapse in high volatility. Without adaptation, every system eventually breaks down. This lack of adaptability is most evident in how traders respond to losses. Instead of asking, "Has the market changed?" they ask, "What's wrong with me?" They blame execution or discipline, which are important. But they ignore the larger reality. Sometimes the edge itself is gone. Professionals know this and constantly test whether their strategies are still valid. Retail traders, on the other hand, keep forcing old setups into new conditions, trying to squeeze water from a stone. They repeat the same mistakes because they cannot accept that change is required. A major reason traders resist adaptability is the fear of the unknown. To adapt means to step into uncertainty, to leave the safety of the familiar. If they abandon their trusted indicator or setup, they feel exposed. They would rather endure continued losses with a system they understand than face the discomfort of learning something new. This fear locks them into cycles of frustration. The market evolves, they refuse to evolve with it, and their results deteriorate while they search for reassurance in old patterns that no longer deliver. Consider how markets shifted with the rise of high-frequency trading and algorithms. Many patterns that worked reliably for decades suddenly became erratic because machines were faster and more efficient at exploiting them. Retail traders who adapted to this change found ways to survive, often by focusing on longer-term perspectives or by refining risk management. Those who clung to old ways were wiped out, not because they lacked effort, but because they lacked flexibility. History is full of these transitions, from floor trading to electronic platforms, from manual charting to algorithmic dominance. The traders who endured were those who adjusted their sails rather than cursing the wind. Adaptability is also about psychology. A rigid mindset views the market as something to be conquered. An adaptive mindset views the market as something to be understood. The difference is profound. The rigid trader says, "This pattern should work." The adaptive trader says, "What is the market telling me now?" One approach resists change. The other embraces it. This flexibility allows the adaptive trader to pivot when conditions demand it, avoiding the stubbornness that destroys so many accounts. Another critical aspect of adaptability is time horizon. Many traders get locked into one style, scalping, day trading, swing trading, without ever adjusting to the environment. But markets are not always suitable for every style. A choppy, low-volume market can destroy a scalper. A sideways, directionless market can drain a trend trader. The adaptable trader recognizes when their chosen style is out of sync and either steps aside or shifts perspective. The rigid trader insists on forcing trades, unable to see that stepping back can be a strategy in itself. The institutions exploit this rigidity. They know that retail traders place stops in the same predictable zones, cling to the same tired strategies, and react the same way under pressure. By staying adaptive, institutions shift tactics constantly, ensuring they remain ahead of the herd. This is why the same traps keep working on retail traders. Stop hunts, false breakouts, liquidity grabs. The herd never changes, and because it never changes, it remains prey. Lack of adaptability also stifles growth. A trader who refuses to adapt never expands their understanding of markets. They may survive for a time, but they will never thrive because they are locked into a single perspective. Every loss feels like a personal failure instead of a signal to evolve. Growth only happens when a trader embraces change, studies it, and reshapes their approach accordingly. Without this willingness, they remain stuck in cycles of mediocrity. Adaptability is not optional in trading. It is survival. Markets will never stop evolving. Volatility will rise and fall, correlations will shift, and technologies will reshape the landscape. The trader who remains rigid will always fall behind, while the trader who adapts will continue to find opportunity even in chaos. The refusal to adapt is what keeps 99% of traders alike and broke, while the small minority who embrace change carve out the resilience needed to last in an unforgiving game. At the heart of every successful trader lies something deeper than a strategy or a system. It is the mindset of independence. Most traders enter the markets seeking guidance, and they quickly become products of consensus. They follow the same books, the same courses, the same voices on social media, and without realizing it, they begin to think in patterns that mirror the majority. Yet the markets are structured to punish the majority. The truth is that the path to consistent success lies in developing an independent mindset, one that allows you to process information through your own filter and act in ways that separate you from the herd. Independence in trading does not mean isolation or ignorance. It is not about rejecting every idea simply because others believe it. Rather, it is about learning to question, to validate, and to think critically. The independent trader listens, but does not follow blindly. They observe consensus, not to join it, but to understand where the masses are likely to act. In this way, they turn consensus into a map of crowd psychology, using it as a tool rather than a prison. This ability to observe without being absorbed is what gives them an edge. Developing this mindset begins with self-awareness. Many traders do not even realize how much their decisions are influenced by external noise. They think they are making independent choices, but in reality, they are reacting to headlines, following the latest opinion of an influencer, or imitating strategies from a forum. Independence starts when you pause and ask, why am I taking this trade? Is it because I see something clearly, or because I've been influenced by others? That simple act of questioning separates a trader from the unconscious habits of the crowd. Another layer of independence comes from accepting uncertainty. The herd clings to consensus because it offers comfort. It feels safer to believe what others believe, to act in alignment with the majority. But markets are inherently uncertain, and seeking comfort in agreement only breeds mediocrity. Independent traders embrace discomfort. They understand that feeling uncertain is part of the game, and they develop the strength to make decisions without needing external validation. This courage is rare, and it is what allows them to stand firm when the crowd panics or to wait patiently when the crowd rushes in. Risk management is also a cornerstone of independence. The herd often neglects it, preferring to focus on signals and predictions. Independent traders, however, see risk as their shield against the unpredictability of markets. They control what they can: their exposure, their position sizes, their exit plans, while accepting that outcomes are never guaranteed. This approach frees them from the emotional contagion of the crowd. When others are driven by fear or greed, the independent trader relies on discipline. Their mindset is not swayed by temporary movements because their foundation is built on control rather than hope. Adaptability strengthens independence. The market is constantly shifting, and independence means refusing to be married to one idea, one system, or one belief. Independent traders treat strategies as tools, not identities. They are willing to evolve, to let go of what no longer works, and to explore new methods without losing their core discipline. The herd resists change because it fears standing apart. The independent trader embraces it because they know survival depends on flexibility. One of the greatest signs of independence is the ability to tune out noise. In an age of endless information, where opinions scream from every platform, the independent trader cultivates selective focus. They learn to filter what matters and discard the rest. They no longer feel the need to chase every headline or follow every forecast. Instead, they build their own framework, grounded in observation, testing, and experience. This clarity of focus allows them to act with confidence while others drown in confusion. Independence is also built through resilience. Losses are inevitable in trading, but how a trader responds to them reveals their mindset. The herd views losses as failures, something to fear and avoid. Independent traders see them as feedback, information that guides refinement. They do not seek validation from being right on every trade. They seek progress through consistency. This resilience allows them to detach their identity from outcomes and stay committed to their process, no matter the noise around them. Ultimately, developing an independent mindset is about taking full ownership. It means refusing to blame the market, institutions, or other traders. It means refusing to hide behind consensus as an excuse. Independence is the realization that no one is coming to save you in trading. The responsibility is yours alone. To prepare, to manage risk, to adapt, and to execute. This ownership may feel heavy at first, but it is the very weight that transforms a trader into the rare 1% who thrive while others fall. Independence in trading is not glamorous, nor is it easy. It demands discipline, courage, and the willingness to stand apart. But it is also liberating. It frees you from the cycle of herd behavior, from the noise of overinformation, from the trap of consensus thinking. It allows you to see the market clearly, not as others want you to see it, but as it is. And in that clarity, the independent trader finds what the majority never will, a true and lasting edge.